Hey everybody, welcome back to Rensing Trades. In this episode, we're going to be talking about what options are. If you've never heard of me before, my name is Richie, aka Rensing Trades, and I sell options in the stock market to produce safe passive income. So in this episode, I'd really like to start off by building a fundamental level and basically try to create a pyramid of knowledge over a period of time with my channel. So as these videos go on and progress through time, they're going to become much more advanced, so you could always go back and watch these basic videos if you just want to refresh yourself, or, hopefully if you are new to the stock market, then these videos are really going to help you out. So stock options are a pretty advanced tool to create, wealth for yourself, but it can also drastically increase the losses for your account. So if you are just starting off in the stock market, I would probably look to, paper trade for a little while and build your confidence, your strategy, the way that you're going to attack options in the market, than just going straight into it and using your money, because what's going to end up happening is you'll be like me and you'll end up losing a lot of your own money. And not to say that that's necessarily a bad thing, because it taught me a lot about what to never do again and to really get my emotions under control and et cetera, et cetera. But if I was you and if I could go back in time and start off, I probably would have done a lot more paper trading to try to perfect my abilities and my confidence levels going into these trades than just going right in, off the bat and losing my money that I was working really hard for at the time. So there are two kinds of options. There are call options and there are put options. Call options, you would buy a call option when you think the stock is going to go up. On the flip side, if you buy a put option, you think that the stock is going to go down. So let's go ahead and open my Robinhood just so that I can show you exactly like what I'm looking at and kind of how to navigate the options chain. So as you can see here, this is my Robinhood. You can see my total portfolio value there. Now, I will say that Robinhood is the best brokerage I've had. The user interface is extremely easy to use. And if you're looking to create a brokerage account tonight, I would say that Robinhood is probably going to be the best brokerage account to create. I may be biased because that's the one that I use, but I really do think, and I've used other ones, and I really do think that Robinhood's user interface is the easiest to use. So anyway, if we were looking at stock options, you have to actually be approved for options. So you would have to go into your account after you created it, and you would have to basically fill out like a little application process, and they'll either approve or disapprove you for options trading. Since options are a lot more volatile, there's a lot more risk involved usually. The brokerage wants to make sure that you kind of know what you're doing before they allow you to trade options. So if we open up our account, the first thing that you're going to do is you're going to try to find a stock that you think is going to go up, or you think it's going to go down, or, whatever. So in my case, I think that Target is actually a really good buy right now. So in my opinion, I think that Target is going to go up. So if we type in TGT, we can see that Target will pop up, and then we can view Target. So right now Target's at $92 a share in the overnight trading, and you can see this tab right here on the right hand side that says Trade Target Options. So you click on that and it would open this very confusing page if you've never seen it before. So this is what's called the option chain, all right? And they call it the option chain because it's, like a chain link fence, like, one after the next. So each one of these values on the side, you can see a dollar amount there. These are what's called the strike price. This is either the price that you are agreeing to buy Target or agreeing to sell Target at, depending on what kind of option that you're trading. So in our case, we think that Target is going to go up, so we would buy a call option. You also see here on the right-hand side that there is a tab that shows how much time we want on the contract. So the further you go out in time, the more expensive the contract is going to become, since you're basically giving yourself more of a chance of making money. So because you're increasing the time, the contract value therefore is going to be increased. So in my case, when I buy options, I don't do anything inside of 60 days. Just because I want to give myself more time, and I'd like, it's a little less risky inherently that since you're adding time to the contract. So I like to go at least 60 days out. So in our case, let's go to July 18th, which is 85 days from now, and that's when this contract would expire. All right, so if we thought that Target was going to go up, let's just say, for example, we can buy this $85 call contract on Target, and you can see here there's a price of $12.50. Now, if we clicked on that contract, you can see that it says max loss $1,250. Well, the reason why it doesn't say $12.50 is because option contracts are worth 100 shares. If I bought this call contract right now, I wouldn't necessarily own 100 shares of Target, but I would be able to control 100 shares of Target. They call it synthetically controlling the shares. So you don't actually necessarily own the shares, but you own the rights to the shares, and the $1,250 that you use will increase or decrease just like you actually owned 100 shares of Target stock. So in this case here, you can see that this number over here, the strike price we've selected is $85. So if I was buying a call contract right here, I would be agreeing to buy 100 shares of Target by July 18th of 2025. Now you might say, why would you not just buy 100 shares of Target? Well, not everybody just has $9,200 that they can just throw into Target. So in this case, we are able to buy the rights to 100 shares of Target for only $1,250. Now, $1,250 is still, a lot of money, but it's a hell of a lot less than $9,200. And that's why options can really drastically increase your gains, but they can also massively increase your losses too, because if Target doesn't go above 85, or it doesn't actually go above our break-even price, which is basically the strike price, and since it's a call contract, we would add the $12.50 to this 85, which ends up making the break-even of $97.50. So in our case, if you look at this expected P&L chart here, and this is based on the date of expiration, so in our case, this would be as if today was July 18th, 2025. If we were at $97.50, we actually would not make but not lose money. And $97.50 is actually more than the share price now. So even just to break even, to not make but to not lose money, the stock would actually have to go in the right direction. But as you can see, if the stock continued to go above $97.50, we would just keep making more and more and more money. Just like as if, we bought, let's say that we bought 10 of these, instead of buying 100 shares, we ended up buying 10. You can see that as we go above $97.50, our expected profit is a lot of money, a lot more than if we just bought 100 shares. But on the inverse side of things, if Target went down, we would actually end up losing every single dollar that we put into the option contract, which is greatly different than whenever you would just buy 100 shares of Target. Because if you were to buy 100 shares of Target right now for $9,200, and then Target went down to 80 by this date, you would still have $8,000 in your account. But if you put the entire amount into stock options, in this case the $85 call, then you would end up having zero by the end of the contract expiration. And that's why option contracts inherently are more risky, because you end up actually losing the entire amount that you put into the contract if it doesn't go in the direction that you say it's going to go in. On the inverse side, what if I thought that Target stock was going to go down? If I think that Target stock is going to go down, we can do the exact same thing we do for the call, but instead we're going to do it on something called a put contract. So the put contract is the exact opposite of the call contract. So if I selected this 110 put contract here, I would be agreeing to sell 100 shares of Target at $110 a piece, but it's going to cost me $2,125 just for the rights to do that. So it's the same thing. We would take 110, and since it's a put contract, we would actually subtract 21.25 to create our break even, which in this case would be 88.75. So we would have to have target stock right now. Target stock's at 92. We would have to have target stock drop to at least 88.75 by July 18th in this case, which is the date that we selected, to not gain but not lose money. But as target, if it continued to go down and down and down in value, you could see that we would actually make a good amount of money. So in this case, you can actually hedge your portfolio. So say, for example, that you had a bunch of target stock, but you really think that the market is oversold, you really think that the market is overbought, and you don't want to necessarily sell your target shares because you don't want to add a lot of realized gains into your portfolio. So instead of selling your target shares when you think that the market is overvalued, you can actually buy put contracts to kind of hedge your portfolio, which is exactly what hedge funds do, is they hedge their portfolio. So when the market is really overbought and these hedge funds think that the market is going to decrease in value, instead of selling off their positions, usually they buy put contracts instead to try to minimize how much the portfolio value is going to go down when the market does decide to actually sell off. So options are obviously a great tool for people with smaller portfolios because you're able to control 100 shares of a stock for a much less price. That being said, though, they inherently are going to be more risky because if it doesn't go the direction you think, or even if it does go in the direction you think, but it doesn't go above the price that you selected or the strike price, you will end up losing every single dollar you put into that trade. So that was just a really quick, really fundamental level on what stock options are. I tried to make it as easy as possible. If you did like this video, make sure to like this video down below. Subscribe to this channel. As I create more videos, hopefully I'm going to be able to show you guys how to really create passive income for yourself and become successful in the stock market. Anyways, guys, thanks so much for watching, and I'll catch you on the next one.